Hi, this is Stephen here from Share Navigator, and today I'm going to talk to you about the dogs of the Dow investment strategy. So let's get stuck into it straight away. Well, this strategy is going to suit time poor, longer term investors who A want to preserve their capital and B generate annual returns via dividends. This strategy will not suit those investors looking for the next big thing, the next Apple, the next Amazon. And it's the simplicity of this investment strategy is why it's so attractive to those time poor investors. This strategy has a significant long track record of outperforming the benchmark index. So let's talk a little bit about those results. The benchmark index we're going to use is the S&P 500. That's the index that fund managers year in year out are trying to beat. So if we look at the performance over the last 5 years, the average return of the dogs of the Dow was 13.4%. The S&P 500 also performed well at an average return of 12.5% per annum. But as you can see, the dogs of the Dow clearly outperformed over that 5-year look-back period by nearly 1% per annum. On a 10-year basis, it gets even better. The dogs of the Dow outperformed by nearly 1.7%. So the average return each year was 15.9% for the dogs of the Dow strategy. And over a 20-year look-back period, so don't forget we had a dot-com crash in the early 2000s. We did 2007, 2008 crash, and we've also had the recent crash due to COVID in that period of time. But the average annual return is still 9.5% for the dogs of the Dow, and the S&P 500 average annual return is 7.7%. So again, it's outperformed by 1.8%. So you can see over the last 20 years, the average look back period, this strategy is outperformed. So let's talk a little bit about some of the negative results. So I just don't want to paint that rosy picture for you. It doesn't outperform every single year. There's anomalies in there, of course. And last year is a great example where the S&P 500 had a massive year, up 31.5%. The dogs of the Dow was only up 19.7%. But over the last 10 years, you will find 8 out of those 10 years, the dogs of the Dow outperformed. So we're looking at the long-term averages here. And remember, that's why this strategy is for the time poor, longer-term investor. So how do we go and do it? It's a very simple thing. We go and look at the Dow Jones Component stocks. So remember, the Dow Jones is just an index that comprises 30 of the largest companies floated on the US stock markets. Simple as that. And then what you do is you find the top 10 dividend paying stocks in that index and you invest equally into them. And then you just keep reinvesting. As they pay out a dividend, you keep reinvesting that dividend into the stock. That's it. It's that simple a strategy. Then your final step is really just to revisit the portfolio in 1 year. You take out the lowest yielding stocks. If there's a higher yielding stock that you can put into the portfolio, you just replace it. And then that's all you do year in, year out. Very simple, and that's why it suits that longer term time poor investor. So let's have a look. If we were to do this strategy today, what would it look like? Well, here's step 1. There's your 30 components of the Dow Jones. Now you can see there I've got them color coded, and I'll explain that in the next slide. But there's the list of companies, and I've organized them in terms of what their highest dividend yield is to the lowest dividend yield. So here's step 2 of the strategy. We're now going to pick the top 10 dividend paying stocks, and you can see there we've got 11 stocks here, and we've got ExxonMobil grayed out. And you might be asking, why are we graying this out? We're not going to include this in the strategy this time, and the reason is quite simply ExxonMobil at this moment in time are no longer able to sustain their dividend from their profits. So in that situation we would remove it from the portfolio and we would replace it from something else. That's not to say further down the line that won't come back on track, but that dividend yield may not be sustainable going forward. So we just simply move on to the next 10 stocks. And that includes Dow, Chevron, IBM, Walgreens, Verizon, Pfizer, JP Morgan, 3M, Coca-Cola and Cisco. And you can see that our average dividend yield per annum is 4.45%. So what does that mean? That means, for every 100,000 you invest into this portfolio, every year you're getting paid 4,500 just for owning them through dividends. You reinvest that money minus your taxes into the companies, and you keep adding shares as you go on. And that's simply it. That's as simple as the strategy can get. You go asleep, there's nothing else to do. You revisit it next year and you replace the lowest yielding stock. That's it. So that's the dogs of the Dow strategy. That's how simple it is you can be investing and being smart and outperform the S&P 500 without having to go and pay all those fund manager fees. If you're interested in learning more, we'd encourage you, if you haven't already done so, to join our stock market community. That's where we have like-minded people sharing trading ideas and learning about the stock market together. Visit www.sharenavigator.com. Thanks and bye for now.